Just tell me if screen is visible to all of you. Good evening, everyone. Okay. Visible? Chala, good to go. Okay. So good evening, everyone. So today is the chapter number 3, Economic Survey. We will be discussing this chapter. Okay. Under this scenario, we will be discussing chapter number 3. I've done something different for all of you. Today I've made a full economic survey summary sheet. Okay. It means the full economic survey I have made in one page. Okay, one page. And I have full economic survey I have made in 5 page for your revision. That one page summary is about the relationship charts, like using arrows and etc. And this 5 page summary will give you pointers to write answers, or if you are preparing for any MCQ related exam, you'll be able to find those conceptual clarity of those points. Okay. Plus today tomorrow I'll be making definition chart as well. Okay. Now these all things I will be giving to you at the end of the chapter number 16. Okay, when we will be discussing chapter number 16, at the end of the survey, we will discuss this with all of you. Okay, so those who will be with me in the whole journey. So it's not in the 16th chapter I will be announcing. I will be announcing these 3 things differently in different period of time. Okay, so that will help you in having short notes of the whole chapter. Okay, so tomorrow is Sunday. We have a special class. Okay, so most probably we'll do that, and after it will take like 4 or 5 more days to redraft that I will be giving to all of you. But this is only for the serious aspirants. Okay, those who are sincerely attending the session. Although I know there is a match going on, India T20 World Cup, and by seeing the performance of our team initially, it looks like they had a deal with cricket as well. And so India, US struck the deal in cricket as well. That's what we have seen in the initial 10-12 overs. Okay. Now the most important thing here is to understand today's chapter. Okay. So we start with this in today's chapter. First of all, I will be giving you the overview of this chapter, which is very important because the name of the chapter, as you can see on the screen, it's monetary management and financial intermediation, refining the regulatory touch. So here we will be seeing according to the regulations and all. Okay. Yes, I don't think so. That's American team. It's like you only found 2 foreigners. In that, one is from Cape Town. So I think only the wicketkeeper belongs to US. Others are borrowed. When you cannot form, you buy. So that's the thing with American team. Okay. All of them must have played in India. Some of them played Indian under 19 World Cup, etc. Okay. So here economic survey that we will be starting today. Okay, Vishaka, there's no issue with that. Yes, Nikhil. Okay, so we are starting the session. Good to go. All ready. Just write ready in the chat box, everyone. I know today the attendance is low because of match, but just write ready. So we'll have 100% of our focus and we'll trust our bowlers that they will get through the line. So we'll not focus simultaneously on both these things. Okay. You can check the score anyways. There's no restriction. Okay. But if you have pen paper, I would recommend you not write anything. ठीक है? So do not write anything. If you have anything in your hand, anything related to your survey, you just enjoy the story. Okay. So this is chapter number 3, monetary management. Here what we'll see is, we will see the regulatory touch as mentioned in the topic as well. So currently the world market, the global market, as we have been discussing in the first 2 chapters as well, and in the current affairs classes and all, we have seen the world is uncertain. That is why you see the rates of bullions, gold and silver and other regions. That's the problem. So the story starts of chapter number 3 is, when uncertainty strikes, market blinks first. This is the note where we can start our lecture. It means whenever there's uncertainty in the economy, even it's global or domestic, market blinks first. So that is why if you see financial data, like as soon as Trump got into the power, we have seen that there is an issue. There's an issue with the investors' confidence, and that India tried to consolidate. Okay. So here we need to understand in certain scenario how economic survey, this chapter talks about uncertainty, talks about how RBI is navigating, how government is also supporting the monetary policy. So I remember Dr. Raghuram Rajan said something. Okay. Now here the most important thing, in order to understand, Raghuram Rajan said that India got 50% return in return of the friendship of Trump and Modi. Now understand, this is a proper technique, proper tactics of negotiating the tariffs. As I told you yesterday, who will bear the brunt of tariff is the American citizens. Okay. So here you need to understand that in the periods of uncertainty, when you see that global economy is uncertain, financial markets always react before the real economy does. Like the prices of gold and silver, stock market investors, we have seen capital outflows from India to abroad back again. But the real economic impact comes later on. You see that textile industry is struggling. That is why exporters got the boost. Okay. Yes, Ishita, thank you. We'll be starting our morning lectures very soon. Okay. Because this economic survey takes time to prepare. Okay. So I have to read the whole chapter. So that's the most important thing. First, we'll understand because this is the most important document for economics. Any exam you are giving, all the questions will come from these chapters, I mean, from 1 to 16. Okay. So economics survey chapter 3, we are starting with powerful, but often there are certain ideas which are missing. Like if you see long before, if you see household cut consumption, okay, or firms cancel investment, market reprice the risk. So before people react, market react. That's what I'm trying to say. And how we got that information? We have seen that equity prices started falling, so capital outflow. Bond yields started rising. Exchange rate started fluctuating. Gold prices started moving up. So 2025, the year 2025, in the global context, if you want to understand from the economic survey, as soon as US announced escalations, since January, like we can say 2025, global markets immediately have done 3 things. One is reducing the dependence on US dollar. Okay. They move towards more safer option like gold and other assets. Okay. And they widened the credit spreads. So credit in the economy spreads. These 3 things happened initially early 2025. So the real economic activity did not collapse immediately like April, May, June. No, we have seen the real economic activity collapsed during the end of the year, like October, November, December, you can see. So economic logic here is, in order to understand that, if you see financial accelerator, there is uncertainty. Whenever there is uncertainty, risk premium is there. What's the risk premium led to? Cost of capital, so increment in the interest rates, etc., etc. And when cost of capital goes up, it means loans become dearer, costly. So when loan becomes dearer or costly, delayed investments are there. Okay. Similarly, you can relate with the stories in the past as well. Like US-China trade war started in 2018-19, if you remember. Then second point is COVID policy uncertainty. Due to COVID-19, we have seen uncertainty. So again, we saw these three things on a similar pattern. That is less dependency on US dollar, more investment moving towards gold, and widening of credit. Okay. Then Russia-Ukraine conflict in 2022, post-COVID. Again, we have seen the same thing. So it means you can say since 2018, the global economy is uncertain. And if you don't believe me, what you do is you go and check the prices of gold since 2018. You just type on Google and you see gold prices trend year on year. You'll find a graph or number simply. You see how much amount of gold that has increased. Now, why I'm telling you this whole story? Because it matters to India. How? Because India is deeply integrated with the global financial market. Even though we have good fundamentals, strong fundamentals, a robust economy, these are strong, but external uncertainty can raise India's cost of capital. So in the monetary management, majorly economic survey talks about cost of capital. Is it clear with everyone? The whole story, the background of this chapter. Okay. Clear in the chat box. So here is the introduction slide, role of monetary management, changing nature of global financial system. Today's financial system is deeply globalized, interconnected. So this integration provided several benefits. What are the benefits? Lower global borrowing cost. You can easily borrow from US and Western countries. Better access to international capital. So we are not dependent only on our domestic capital. Improved international risk sharing. So if one country will struggle, other will also struggle. So everyone will try to protect that. Okay. So that's the role of monetary management here in this time. Now, financial markets now transmit global disturbance. It means whatever will happen in this, it will be visible in global disturbances more quickly and intensely. It means quickly it will be visible. The issues that will happen will be translated quickly. For emerging markets like India, there's a double challenge. What is it? So we need to harness, it means take benefit of global finance, and we have to limit our exposure to volatile capital flows and external instability. Like for example, in India, if you see housing prices. Now in India, affordable housing, nobody is making. Everyone is making luxury housings. And these HNIs, high net worth individuals, entering Indian real estate market. Previously, they entered into capital market. So we have seen huge amount of growth in the capital market. Okay. But here, we have seen the difference in high net worth individual in housing market as well. Okay. Now, global financial markets, uncertainty and emerging market risk. Okay. So financial markets as first responders to uncertainty. As I told you, the first reflection you will see here. So the year 2025 was marked by heightened global uncertainty, which is significantly influenced asset prices, capital flows, and risk appetite. Three things. So risk appetite comes with investors' confidence in the cost of capital. Capital flows means the money that is flowing from developing country to developed country. Asset prices means gold and silver. Now, what are the trigger? It means the policy, geopolitical uncertainty. So, major episode of volatility emerged in 2025. Tariff announcement, we have seen that, we are aware about that as well. Global equity markets declined. That's the first reaction we have seen. Stock market, share market everywhere in the world has seen the similar scenario. Risk premium rose across corporate bonds. So, when there is high risk, the cost of capital goes up. Gold prices surged as investors shifted to safe haven asset. It means when investors feel that the currency is not worth their investment, there's a lot of fluctuation in the stock market, in the paper currency, they move to hedge their investment into bullions. Okay. So bullions are like precious stone metal, and gold is one of the most popular one. Reduced exposure to the US dollar as well. So India bought Russian oil in ruble, in rupee. Okay. And that rupee trade recently we have seen when President Mr. Putin came to India, India also increased its rupee trade to Russia into a Vostro account. Okay. So if you're not aware about this, we don't have time to explain that, but it is simple. Russia opened one bank account in India. If India buy oil from Russia, India deposit Indian rupee into the Russian account opened in India. Okay. And then when, for example, Russia needs to invest in India, in infrastructure and all, we take the money out from their Indian account in terms of Indian rupees and we invest on behalf of Russia. So Russia is selling oil and getting investment in India's infrastructure. Okay. When some tariff decisions were later reversed, volatility subsided, showing how policy signals can quickly amplify calm financial stress. So we have seen recently FTAs with other countries, regions, etc. We have been discussing since chapter 1. So this has grown the confidence of the investor, and we have seen the prices in the gold and silver both went down significantly. I've seen that the stock market went up as well. So you can see how quickly financial market reacts. How prolonged uncertainty hurts financial system? The number one is investment delay. So when there is uncertainty, private investors do not invest. They wait and watch. Okay. They postpone their spending because unclear future returns are there. So nobody wants to fire their shot in the dark. Okay. So everyone has to see the target. If target is not visible, where will you shoot? It's like shooting arrows in the dark. Okay. So that slows capital formation and economic growth. Then the higher cost of finance, it means the interest rates. So when higher interest rates are there, that's the biggest problem for India as well. Cost of finance is very high in India. So borrowing becomes expensive, and where borrowing becomes expensive, credit flow to business and household, that weakens. Weak ho jata. Risk of market correction. So long period of elevated uncertainty can cause sudden asset price crash. So if uncertainty is there, market correction is obviously there's a risk of sharp market correction, which is not what we are expecting. So in financial market, investors appreciate some kind of predictability. Okay. Then we have why this matter in emerging markets like India. Like for emerging market, global uncertainty leads to volatile capital flows. So suddenly, if suppose, for example, in India, okay, so I'm making the map. Don't take it otherwise. My drawing is so bad. So suppose, for example, the capital is flowing out of India. So investor will demand dollar in return of rupees. Okay. So rupee they will give to RBI and ask for dollar. What will happen to our foreign exchange reserves? Our foreign exchange reserves will deplete. So when volatile capital is there in India, It is difficult to control the decline in the foreign exchange reserves, although we have good amount of forex cover, but still, if the volatile capital is more, then it's a problem. If you want to read more on that, you read a 1997 Asian financial crisis. Same thing happened in East Asian Tigers economy. Exchange rates, bond markets, equity markets, they become more vulnerable. Okay. Domestic financial systems must be resilient enough to absorb that external shock. It means if foreign institutional investors are moving out, then domestic investors must take their place in order to put funds back into the economy so we can stabilize our markets. Is it clear with everyone? This line very important. Is it clear with everyone? Clear, 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 clear. ठीक है बेटा पूरा रिपीट करना डिफिकल्ट होता है पूरा रिपीट करना मतलब पूरा 10 मिनट फिर से समझाना इट्स डिफिकल्ट यू हैव अ डाउट यू आस्क स्पेसिफिक क्वेश्चन इट्स नॉट लाइक मैं गाना गा रहा हूं कि सर बहुत अच्छा लगा फिर से सुनाओ बेटा अगर कहीं बीच में इशू आ रहा है तो आप वही यू इंटरप्ट मी इन बिटवीन बट इफ आई जस्ट कंप्लीट द होल सिनेरियो एंड देन यू से सर वंस अगेन रिपीट इट्स नॉट पॉसिबल है ना you can repeat always you will get the recording of this you can repeat it okay last one is simple that domestic financial it means if foreigners are taking capital out of India our domestic market must be strong enough to invest back in India the difference okay that's what I'm saying so if foreigners are asking for dollar making dollar strong and making rupee weak that we have seen rupee cross 90 marks है ना 90 per dollar so here domestic institutional investor must be strong enough to stabilize that economy so India is doing this as well and this okay now this is monetary developments what exactly happens so here we'll talk about more RBI more about its monetary policy committee okay now listen carefully I'll just give you the background on that so whenever there is some kind of uncertain backdrop in the economy RBI face classical dilemma every central bank has a dilemma of growth versus inflation if they push more growth then inflation will be sacrificed and vice versa if they control inflation they will sacrifice the growth so that is classical central bank dilemma every country faces okay now here we need to understand that if RBI tighten the fight to fight future inflation or it will ease to protect growth and transmission that's the question always RBI is having so RBI's answer in the survey according to it is in simple sense RBI said that yes all depends on data so RBI adopted growth supportive but cautious approach so you can see some kind of a balance that RBI is finding you can read from this slide so repo rate currently it is even in the February monetary policy committee report now although the survey came before that but yes we know so MPC shifted its stance from accommodative to neutral what does it mean accommodative means we are ready to reduce more interest rates but when they say our stance is neutral it means we will see according to the data in the month of February or in the month of April we'll see according to the data and we'll take the stance take the decision okay so neutral stance gives flexibility to respond so that everyone knows that all depends on data RBI is not accommodative to reduce more interest rates There's another word called hawkish. Hawkish means when RBI is more cautious and increasing the interest rates. Currently, it is not the case. Okay. So our neutral stance gives flexibility to respond to evolving inflation growth dynamics without pre-committing to further easing. What are the implications here? Policy is no longer aggressively expansionary but remains supportive of economic activity. So we are not sacrificing economic activity, but it avoids commitment to future easing. It means there's no commitment that RBI will reduce the rate, and it preserves room if inflation surges again, then RBI can increase the interest rate as well. Okay. So neutral stance does not mean indecision. On my Instagram page, somebody asked me, sir, don't you think so that RBI is uh, some kind of not able to decide anything? That is why they are having neutral stance. I said that no, it's not indecision. It's like option value in uncertain times. So if any uncertainty comes in, they have the option to accommodate, maybe to keep the interest rate intact, increase it or decrease it. Okay. Now, if I talk about liquidity, liquidity means how much money we have in the market. Okay, like for example, if I ask about your liquidity, so when you grow up or when you're working, you have certain amount in your fixed deposit. Okay, when you see that there was some amount, we can say, in your home as well. If you bought a home right now, you all are preparing, but just imagine, but some money is in your bank account. Okay, some money is in your bank account. So that bank account money is the liquidity. So in the same line, what exactly it is? Okay, better that 100 basis point and 125 basis point given in this survey. It was, yeah, so ये 125 होना चाहिए, सही कह रहे हो है ना, maybe must have been a typo. So from April to December, you can consider 100 on the same lines, because that 125, if we are taking, we have to take from the month of February last year. So from February to December, it was 125. And as far as I remember, if you take from April to December, maybe it's 100 because 25 basis point was the cut. So we have to check the data, not very important data, but yes, you can say from 6.5% the repo rate till date 5.25. RBI reduced CRR by 100 basis point to 3% of NDTL, net demand and time liabilities. Demand liabilities means the money in the deposit account. Time liability means the money in the fixed deposit and the recurring deposit, RDs. Okay. Now this implemented phase between September to November. So this reduction in 1%, that is 100 basis point from 4% to 3%, released 2.5 lakh crore of durable primary liquidity in the banking system. Okay, I'll give you a simple understanding of this. Suppose you are the owner of the bank and you opened a bank with a capital of 100 crore. Now RBI says that 4% is the CRR. Okay, it means that 4 crores you have to give to RBI. This will go to RBI. Now, if suppose, for example, RBI reduces this by 1% or 100 basis point to 3%, it means from this 4 crore, now you have to keep with RBI, the amount is 3 crore. It means you got extra 1 crore to give loans in the market. So that increases the liquidity. That 1 crore in our example is in reality is 2.5 lakh crore in the Indian economy. Is it clear with everyone how CRR reduction created liquidity in the banking system? Okay. So more lendable resources with banks, that supports credit growth and lower funding pressure. So the pool of loanable funds has increased. Clear everyone? So that liquidity So always the policy rate is the signal, liquidity is the force. Okay, if you want, you can write this line. Policy rate is the signal, liquidity is the force. So even after rate cuts, if the liquidity is tight, then the transmission fails. Okay. So transmission fails. I'll explain it in some time. What is transmission? Okay. So this is a policy corridor and a call rate. So you can see how the bar is shifting. So you can see the fluctuations are always within the limit of RBI's control. Okay. So large scale open market operation, we have seen that. System liquidity moved in a like a sustained manner. So you can see there's no hardly any big fluctuation. One or two fluctuations we have seen. Okay. On what indicator RBI decides inflation? Beta, there's a target according to the monetary policy framework agreement. There's a target of 4% plus minus 2%. That's an agreement between government and RBI in 2016, which is known as Monetary Policy Framework Agreement. Okay. SDF replaced reverse repo rate. So the difference between standing deposit facility and reverse repo rate is just of collateral. So SDF is better than reverse repo. Okay. Clear, everyone? So if banks do not want to lend money, they can earn the interest rate under SDF. Okay. ठीक है. This is appreciation should go to Ministry of Finance. Okay. So whenever you see CRR adjusted, it's always expansionary. It means without printing the new money. That's why I love the work of RBI this time. It means government is giving full support to RBI that you control inflation without sacrificing the growth. So RBI में इतने होशियार लोग बैठे हैं, वो अपना दिमाग लगा रहे हैं. It means without printing new money, they are fueling liquidity in the market. बड़े बड़े समझदार गवर्नर आए गए चले गए. We have not seen these kind of things. When reverse repo was a problem, they introduced SDF because reverse repo के अंदर collateral लगता था. Now, if you see liquidity condition, so you can see some of the data is there. LAF liquidity adjustment facility matlab simple. Under this, RBI announced a repo rate. Open market operation is buying and selling of government securities. Government securities. So this is the data that you can see. So this 2.39 lakh crore injected via OMO. So you can take back anytime when you want to tight the liquidity. Additional 1 lakh crore for OMO plus USD INR swap. Then liquidity adjustment facility. So that remained in surplus. And banking system behavior. So lower MSF, emergency borrowing, overnight borrowing, higher parking of surplus funds under SDF. So banks took that. When investors are not confident, they are not borrowing, they can park and earn the interest rate from RBI. Okay. Now this is what it is important. Role in monetary policy transmission. Transmission in simple sense, when RBI announced something, okay, then what banks are following? If RBI is saying that I'm reducing the repo rate by 100 basis point, okay, then how much banks are following? So if transmission is around 70, we can say decent. If it is less than, it's not a fixed, okay, I'm just giving example. Suppose, for example, it is 50 or it is 90. Transmission depends on the range, okay. Now, here we need to understand that financial intermediaries act as a bridge between RBI policy and the real economy. Okay, it's like if I am saying something and you are complying, if I say something, do revise data, do write examples in your answer. If you are following that, it means my knowledge is transmitting into your mind. So, the same lines, if RBI is doing everything possible, but banks are not transmitting, then repo and or monetary policy is ineffective. ठीक है? Yes, beta Aditi. ठीक है, so diversity of intermediaries. How? Banks are there, NBFCs are there, microfinance institutions, capital market, digital fintech platforms. So we've seen. Then mobilizing savings, allocate credit, manage financial risk, enable smooth transaction across the economy. You know, with the introduction of UPI, India is far ahead than Western countries. At least 10 years we are ahead. And if you go to Singapore, you will find UPI then and there without any exchange rate. So UPI transformed. Now they want our technology of UPI. I remember I used to like travel in train when I was like a kid. I used to worry about mobile phone and wallet both. At that time I was thinking that अगर ये wallet से छुटकारा मिल जाए. I was not aware that UPI will come someday because at that time there was no smartphones. Nokia 1100 was there. Many of you were like infant, were just born. So here the most important thing is the technology. The transmission is important. Now, how changing pattern of credit flow? Recent trend, we have seen rise in non-bank sources of finance. So especially large firms, apart from banks, they are giving. So credit growth, bank credit growth slowed in financial year 26, but this was offset by rising non-banking intermediation because they give loan easily. Okay. Corporate bond issuance, external borrowings, these also increased sharply. So it means investors are trusting our corporate governance and corporates growth. Large corporates are relying more on market based funding and internal accruals in comparison to the bank sources. Like, for example, Tata need to build parliament. So they can borrow money from the bank or they can raise capital in the capital market. MSME is still dependent mainly on bank credit. Like, for example, at Ecoholics, we have to build the office. Okay, that office required. So we are not public company. Our shares are not traded in the capital market. So we have only one source, which is bank. Okay. The reason was transmission and uncertainty. Transmission is one of the reason and the uncertainty of the investment. Like, for example, if you get 5 crore of loan right now at suppose, for example, 4%, this is the best possible rate. But will you take the 5 crore loan, Aditi, to buy a house? The answer is you have to pay the EMI. So if you are not confident about market and your income, you will not take that loan. So one is investor confidence due to uncertainty. Second is transmission. Okay. So government has been trying its best, but still the economic scenario, you have to wait and watch. Okay. Then regional rural banks. So these are the indicators. Okay. So in rural and urban areas, semi-urban are key financial intermediaries focusing on marginal farmers, small farmers, agriculture labor, small trader, rural industries. Now government reforms strengthen that. So consolidation under one state, one RRB. So it reduced 196 to 28 banks. So RRBs were like struggling. Deposits were very less. The reason is very simple. I went to a survey 2 years back, live survey, I'm telling. If a person is having 100 rupees today earned, now that person will keep that 100 rupee cash, will not go to the bank by spending rupees 20 on like one way or the other to deposit that money which is now he left with 80 rupees because 20 rupees there's a bus fare because bank is far away, 10 rupees one way. So nobody will go to the bank and deposit the money. So there are several other reasons. That's one of the practical reasons I have interacted. So integration of core banking systems, that is another reform that government introduced, and unified branding and technology platform. So instead of having different, you just have one single entity. More trustworthy. Rural people trust more on one single entity than several other. Okay. So the answer is like what Aditi said. So survey answered the most important question. What? Why the transmission is weak? What the perform? Okay. So the reason is simple. As I told you, fresh loans, outstanding loans, still lowest level since 2022 is still lower borrowing cost, so supported housing demand, MSME credit, working capital needs, all are there. But still, effective monetary policy transmission depend on liquidity condition. And a liquidity condition one. Second is bank ki health, house bank health. E means NPA. Not merely if you just reduce the interest rate. Yes, Amar said banking sector structure. That's also one of the things. Yeah, NBFC dominance is also one of the reason we can say, but here the demand is the more important one, not the NBFC dominance, because NBFC provides at a higher rate. Okay. So scheduled commercial banks capital to risk weighted asset ratio stood at this. So that is a strong capital buffer. So we have very much strong banking structure. Historical improvement. So NP improved. Multi-decadal lows. Net NPA at the record lows. Improvement visible across major sectors. So this is a performance that we have seen. Now this is sector-wise gross NPA trend. So you can see industry. So GNP fell from 2.3 to 1.9. Declined from this to this in services sector. So again you can see personal loans fell from this to this. Agriculture is still high at 6%, although slightly improved. Agriculture is very uncertain sector. So funding agriculture is a different ball game altogether. But here you can see the sector-wise NPA. It means the industries are recovering post-COVID. So agriculture remains pocket of stress. Total share in NPA has risen. But you know that agriculture one good month can pay everything sorted. Plus agriculture requires support from the government because it provides food security. Okay. So rising profitability, return on asset, return on equity, these two things we have seen. Okay. Overall assessment, Indian banks now have healthier balance sheet because companies are also doing well. So when bank fund companies, if companies are doing, banks balance sheet also improved. So low NPA, high capital buffer, strong profit for the banks as well. This supports financial stability and credit growth, which in turn supports economic growth, and that we have seen in the festive month, September, October. Okay. So here, these are the things, because this is the most important thing when it comes to Indian banking sector, because last decade, I remember since 2008, Indian banks struggled a lot. So CRAR of 17% is very high, very comfortable position. If you see this 17.2%. Okay. Recovery rate also doubled. Now these are the performance of RRBs. So you can see credit growth is there. So RRB continue to fulfill their development mandate, like priority sector lending 75% to adjusted net bank credit. It means if they are giving 100 crore in loan, 75% must be go to priority sector lending. And what are priority sector? Agriculture, finance, MSME, and weaker sections. So unlike many commercial banks which are like going for profitability over the welfare, RRB remains deeply with the inclusion objectives. Okay. So here you can say profitability, asset quality, capital adequacy towards risk, credit deployment and inclusion role. All trends are showing like a positive picture. Okay. And this is not just the data. If you see nearby your region, there are certain red flags as well. Like if you see gold loans, loan against gold jewelry, that grew by 125%. The reason is simple, because people have gold, they want liquidity. If you see year on year, loan against gold jewelry increased by 120. That's a red flag. Household liquidity also needs this. Okay, so asset price booms can distort the credit composition, but credit composition means how much credit from which space. Like for example, you take credit card, personal loan, home loan, vehicle loan, on the same lines, gold loan. So gold loan surge, it means collateral channel of monetary transmission has seen improvement. Year on year means, if I say year on year, it means currently we are in the month of February. So February of 2026 compared with February of 2025. So whatever period I'm taking, year on year means exactly 12 months back. Okay, like you see your improvement from last year's your birthday to this year your birthday. Okay. Now, major policy actions in the banking sector. What are the major policies? So here you can say structured, transparent regulatory design, standardized consultative approach. So here you can see all I have already discussed with you. Regulations are there, standardization, consultative approach. It means whenever bank needs, RBI work as a big brother. Okay. Impact analysis will be conducted, issuing regulation, mandatory public review for regulation has been institutionalized because you are handling public money. So RBI wants everything to be properly regulated. Okay, review criteria, original regulatory objectives, supervisory experience and surveillance findings, court ruling, global standard, best practices, relevance in changing economic and financial environment, scope of removing duplication and outdated provision. It means unnecessary regulation, banks should not be indulgent. Make it simple, make it more accountable. Okay. Now, digital credit assessment model for MSME by PSB. It means how you can assess by giving credit. So, public sector banks launched a technology driven CAM model to transform MSME lending. Lending means giving money as a loan. Okay. So, uses digital footprints, verified data sources for automated loan appraisal. So, it will be like a fast track approach. That's what NBFCs also following. Okay, when you take money from any NBFC, there's hardly any paperwork. Everything is automatic. They fetch your details, PAN card, Aadhaar card, then CIBIL reports it. So these things relies on these areas: bank statement, ITR, credit bureau data, KYC, fraud check. So they check on these. So this is again time efficient plus non-interactive, like CGT MSC. Central government gives OD limit, overdraft limit. It means your account can be allowed to go into minus, and they charge per day interest rate on the capital. Okay. So that is improving the risk coverage. And this guarantee CGT MSE, loan given by bank, but guarantee given by government. Okay. So like for example, if CGT MSE gives me loan of 20 lakh rupees, it means my bank balance can go up to minus 20 lakhs. And the money that I'll be using will be charged at, for example, 10% per year, calculated on per day used funds. Okay. Yes, we can say, Aditi. Now, massive consolidation of RBI regulatory instructions. So again, you can say 9,000 plus circulars and guidelines consolidated. That's very difficult to read. Reorganized into 238 function specific master direction. NABARD instructions to RBI, cooperative banks were also aligned. So it means they have built a hierarchy. Okay. So that improved clarity, accessibility, coherence, etc. So all in all, ease of doing business in the financial sector has improved. So you can use these words in your answer writing. And creation of regulatory review cell. So to make a regulatory review systematic and continuous, RBI made us sell. It means it's not just trusting. So regulation once every 5 to 7 years, they will review that. How? Comprehensive, objective, systematic. It means it depends. If the economy changes in the next 5 7 years, they need to change the regulations. Okay. So an independent advisory group on regulation with external expert has formed to strengthen stakeholder engagement and bring in industry expertise. This is very important because India is opening the economy in 2026 again. After 1991 economic reforms, you can see almost 35 years. Right now, deliberately, on our own will, we are opening our economy once again. Principle-based AI guidance, RBI's free AI framework. Within the upgraded governance architecture, RBI introduced principle-based guidance for artificial intelligence use in finance. What's the key idea? Balancing innovation, risk management, rather than treating them as trade-off. Okay. So innovation and risk management, two things. It's not a trade-off. It means it's not like one after the other. It's like both. Innovation must be required, but risk management must also be simultaneous. Okay. Now the free AI framework responsible for AI adoption, strong governance and risk control, support for innovation and financial services. So this aligns India's financial system with emerging global AI regulatory trends while ensuring financial stability and consumer protection. Now it comes to microfinance and financial inclusion. Very important, microfinance, regulatory and institutional. So survey shifts the tone. Okay, if you want to write this line, you can write. Survey shift the tone from optimism to caution. Survey shift the tone from optimism to caution. So RBI reduced the qualifying asset requirement of NBFC MFIs 75 to 60%, giving them more flexibility in portfolio management. Okay, I'll explain what it is. Okay. Self-regulatory organization impose lower loan size caps, limits on total borrower indebtedness. These measures led to early signs of stabilization with decline in risky assets and improvement in solvency ratio and disbursement of FY26. It means very simple sense. If you have massive expansion in the economy, more riskier loans are generally given by that. Okay. Like post-pandemic, in order to boost the pent-up demand, the demand was like sluggish. So to pent up the demand, to pick up the demand again, this has been done. So multiple lenders chasing the same borrowers. So if I borrow money from one lender, I receive 10 more calls. Sir, loan chahiye kya aapko? Okay. So result in RBI wants portfolio correction. RBI wants to reduce the stress. RBI do not want to give loan to the over-indebted borrowers. Okay. So in order to understand simple sense, RBI's response is that you need to tighten the qualifying asset norms. What is asset and what is not? For a bank, NBFC giving loans, it means that loans are the assets. So they capped the overexposure because overexposure can bring risk to the system. So survey says in simple sense, financial inclusion without credit discipline can undermine the stability. Like for Indian economy, stability is the most important thing. We cannot take risk. हम धीरे बढ़ेंगे, आगे बढ़ेंगे, but we'll focus on our stability. Okay? Is it clear with everyone? So financial inclusion without credit discipline can undermine stability in the Indian economy. Okay. So similar to like subprime lending happened in 2008, if you remember, small loans, big systematic risk, subprime borrowers. Subprime borrowers means if I am a secured borrower, so I will be called as prime borrowers. It means I have a history of returning back the bank's money. Are you getting my point? But the most important thing here, you need to understand, subprime borrowers are risky borrowers. Suppose, for example, I don't have capacity to pay back 1 crore loan, but I got 1 crore loan. That is lending to subprime borrowers. Okay. Same thing happened in 2008. So that is why for India, it is important to give priority to the stability. Okay. Aditi, is not machine learning. It's simple sense. You have the database. Everyone can access that. In simple sense. Okay. So India witnessed transformational expansion in financial inclusion over the past decades. Rapid rise in account ownership. So bank account increased from 35% to 89%. Jan Dhan Yojana, you can see. Gap in access between rural and urban, rich, poor, male, female population narrowed significantly. That's a brilliant thing that government has done. Yes. Yes, less civil score, we can say. Shift from access to uses. So previously it was access to the bank account, access to the payments, access to the savings. But now people are using that because they don't have. People say, sir, your bill is 122 rupees. When you give a cash of 500 rupees, the shopkeeper will say, sir, I don't have the change. Can you just do UPI? तो पहले होता था ना कि आपने 2 रुपए की टॉफी ले ली शॉपकीपर से, उसने कहा खुले नहीं है सर, ये लो 85 रुपीज ले लो या 500 के नोट में से ले लो जैसा भी है, एंड देन यू टेक 2-3 रुपीज ऑफ चॉकलेट या टॉफी समथिंग लाइक, और या फिर बाद में ले लेना, बाद में दे देना. These things gone. Nobody wants to indulge in that. So from access to usage, measurable improvement in inclusion quality, like financial inclusion index, covering access uses this. So again, people are using improvement across all three dimensions, shows progress beyond mere अकाउंट पेनिट्रेशन. तो पहले अकाउंट खुले फिर उसका यूज होना शुरू हुआ, 10 साल लग गए बेटा, 10 से 12 साल हो गए. देखिए now for this financial inclusion, प्रधानमंत्री जन धन योजना, so details are there. It's easy. 2014 में लॉन्च हुआ था, 55+ crore account in open this. Large share in rural and semi-urban areas, so you can see people are having. DBT transfer subsidy you will get here. Saving habits बन गई, link कर दिया insurance and pension, so auto debit and everything. EMIs, so all linked with your account. So from access to usage. Now this is target credit scheme, Mudra Yojana. Ecoholics even got under Mudra loan for infrastructure. Okay, Savan Nidhi, Stand Up India. So women entrepreneur, SC/ST entrepreneur, loan, working capital given to street vendors. I saw one of the street vendors posted a certain portal of this. I asked what it is. He said that I got a loan of 50,000 rupees to start my fruit ठेला. So again you can see that ठेले वालों को भी क्रेडिट मिल रहा है. क्रेडिट मतलब लोन का क्रेडिट, ओके, नॉट द क्रेडिट ऑफ कॉन्ट्रीब्यूशन. ठीक है. डिजिटल पब्लिक इंफ्रास्ट्रक्चर, रेगुलेटरी इनोवेशन, यूपीआई पेमेंट्स एज गेटवे टू इंक्लूजन. So low cost, real time, converts bank account actively using financial tools, etc. So account aggregator, so sharing financial data, banking, GST transaction with the lender. So all on all, there are cross checks in the economy. Everyone knows about these things. Now, how these drivers reinforce each other? Government program, open the bank account. Digital infrastructure, make account usable via UPI. Combined impact, increased transaction. And the activity has increased. Then provided micro loans, created digital credit footprints, okay, and enabled repeat and larger loans. Then targeted excluded group, those who left, so reduced transaction and onboarding cost, lower barriers to entry. Make sense? अच्छा, मेरी स्क्रीन पे जो चैट बॉक्स रहता है वो आपको भी दिखता है क्या? इज दिस चैट बॉक्स विजिबल टू यू ऑन माय स्क्रीन? नो? ओके. Because on my screen there's a floating chat box, so I keep on shifting that. That's why I asked. If it is not visible, then there is no issue with that. Okay. Now, performance of Insolvency and Bankruptcy Code IBC started in 2016. That was very important. In 1991, in the Indian economy, companies got a right to entry. Then in 2002, with the Competition Act, companies got right to compete. But there was exit missing. So 2016, Indian economy gave right to exit. So right to entry, right to compete, and right to exit. This is Insolvency and Bankruptcy Code. So if the company shuts down, they should be like able to exit it as soon as possible. Okay. Like for example, if we talk about India's capital market, domestic institutional investor now hold more equities than foreign institutional investor. That is why we are not scared about any global activities. Okay. Mutual fund, everywhere you see ad, SIP and all. So retail investors also participate. So when you see resolution in simple sense, it is very vital that IBC must be there. So delays in resolution, so you can read this. Corporate insolvency resolution within 330 days. In practice, the average resolution is 713 days. Cases closed for this even higher, 150% longer than the legal limit. So such delays reduce the recovery value of the firm asset, deteriorate. Employees leave, business relationship weaken. You must have seen in your city, just tell me, yes or no, if you have seen. In your city, you must have seen in a posh area where the land value is very high, one property is lying idle, like half constructed, or it was disputed, or something like that. You must have seen in your area. So, insolvency and bankruptcy code can free up those assets so that we can use it for some productive thing. And if it is lying idle for huge amount of time, then they don't get value. If they don't get value, how will they pay the debtors? Okay. So this is a burden on NCLT. As of March, you can say pendency is somewhere around this much. Current disposal rate and implied clearance close to 10 years, which is severely undermines the objective of the time bound resolution. Okay. Then shortage of resolution professionals. So we don't have professionals to dispose the cases. Okay. Can you hear me? Back again. Technical issue. I'll tell you what happened. ठीक है. Okay, thank you for waiting. And I'm just sharing the screen back again. Screen visible again? Okay. Okay, let's resume. Just one thing happened. We lost all the scribbles. Whatever I scribbled on the screen, that's now gone. Not able to save that. Okay. So we were discussing about the burden on NCLT. So you can see the cases are huge. Okay, cases are huge. Shortage of a resolution professional. It means the cases are pendency of cases are huge. Still, we don't have many people to dispose of those cases. So that's the problem. Limited success. 14 admissions in 4 years, pre-pack insolvency. Lack of awareness among MSMEs, lenders, debtor-led process. So a lot of still the constraints are there. Now this is the IBC amendment bill. So government is introducing the amendments. Okay. So recognizing these operational challenges, proposed amendment bill to reduce procedural delays. Okay. Strengthen institutions process so that government's institutions are having more capacity to dispose of cases. Introduce the framework for cross-border insolvency resolution. That is also very, very important. Now this is very important development of capital market. As I told you that depending only on banks capital limits the growth. Okay. So limited household participation in the debt market, that also created some kind of avenues. Okay. So despite surge in equity participation, retail involvement in market based debt instruments remains weak. It means still people are not investing in the corporate bonds, government bonds, etc. All debt instrument, not equity. Okay. Debt securities from form only a small share of household financial assets. So people still prefer keeping money in the fixed deposit, in the bank account, or even in the cash format. Okay. Now here we can say the regulatory and market reforms are important. What kind of reforms? Like SEBI introduced requests for court platform to improve transparency and to improve and retail access so that people can easily aware about things. They can request the code, they can understand the transparency, companies working and all. Strengthen credit rating governance so that the norms must be easy and investor gain the confidence. RBI enhanced settlement system, tri-party repo, CDS guidelines, etc. And promotion of these trust for long-term capital into infrastructure and real estate. Like for example, a common people now can invest in highways. So if you buy highways, you then when Indian government is building highways, you can get benefits out of those highways. So investing in Indian highways, as low as like 500 rupees you can invest. So everywhere highways are building, so your capital will also grow. Same with real estate. Then we have measures in equity derivatives market. So to curb volatile and improve risk monitoring, exchanges were asked to standardize expiry days like Tuesday, Thursday. SEBI revised open interest calculation, position limits, eligibility norms, intraday monitoring position limits. So these are the things not very important for your examination because capital market does not generally come in the examination. Okay. But these things are working like a reforms. Okay. So these steps aim to ensure orderly marketing function while maintaining the liquidity in the market. Foreign portfolio investors, so you can see FPI flows in India 2026 financial year 26, it means current financial year, marked by sharp shift between equity and debt segments. So equity means all the risk, debt means you are giving loan to the company, company will give you the return. Okay. So that reflects changing global financial condition as well and investors' risk appetite. So investors are not taking risk, going for debt instruments, more safer option. Why did FPI pull out of equities? The reason is underperformance of Indian equities related to other major markets. So they are finding more lucrative opportunity apart from India. Next, global trade and policy uncertainties because of Trump and tariff and the wars going on. Depreciation of Indian rupee, that's another issue. Global risk of sentiment driven by elevated US bond yields. So that is also again the issue. So here you can say, if you see, you will get assured return, and here you will be getting risky returns. Where you will be investing? Obviously, where you will be getting assured return. So when equity markets fluctuates, people move towards more safer option, which is like bonds. Okay, these particularly hurt export-oriented sector like IT, healthcare, where foreign investor reduce the exposure. Okay. Now shift toward Indian debt. When equity flows weakened, debt flows improved. So that's a good sign for India's investor as well. Like if you see the spread between Indian and US 10-year bond yield narrowed to 165 basis points, making Indian debt less attractive in comparison to the US. Because if you are getting the same return in US and India, where you will be investing in a safer market. Okay, obviously in US. So that's the reason. So Indian yield increase, US dollar weakened. So that's what we have seen in this scenario. Okay, but these things keep on fluctuating. When you'll be writing the examination after 6 months, these things will change. So, okay, so don't have to think about much about these concepts as well as the data. Here you need to understand that people are moving from equity to debt. That's the most important thing. Take away from this. Okay, because the only thing matter is FPI exit always. Whenever global shocks are there, FPI will exit. But market is no longer collapsing right now. Market is not collapsing. Why? Because our domestic investors are having strong investment control. Simple. Gift City, you must have heard about Gift City. Many Indian firms access global capital, manage offshore investment through centers like Singapore, Mauritius, Cayman Island, etc. Okay. So these things are important. Gift City aims onshore, offshore financial activities. Okay. Reducing capital outflows, attracting multinational banks, funds, fintech firms. Like, have you ever been to Gift City? Anyone living in Gujarat? Positioning India as a net importer of financial services rather than exporter of capital. So again, India will become good attraction for this. Okay, emerging international role. Two major 2025 developments highlight Gift City growing global integration. Sri Lankan bank listed green bonds on a Gift City exchange. Okay, and first foreign corporate listing marking Gift as a regional capital rising platform. Okay, then launch of foreign currency settlement system, enabling foreign currency transaction to be settled within Gift rather than through overseas correspondent banks. Okay. Not audible. बेटा अब अगर ऑडिबल नहीं होता तो इतने देर से बहुत लोग बोल देते. Even the admin is also listening. Now, performance of the pension. So, strong pension system. Why it is important? Because our demographic dividend will become old later on. Plus, India need funds of that pension to invest in infrastructure sector. So, two things are there. Okay, the share of people aged 60 plus is projected to rise from 10% to 14%. Working age population will increase only marginally. So we need a strong pension system to make India a healthy sector. What are the reforms? Unified pension scheme introduced in 2025 reflects efforts to modernize government pension structure while maintaining long-term fiscal discipline. So government should not bear the burden of pensions without any productivity. NPS Vatsalya, a child-focused pension initiative promoting early cycle saving benefits. So again, child-focused pension initiative. So you can see early in the life, people can invest in that. Digital integration, so Aadhaar-based everything. So to have authenticity and all, micro contribution via digital payments can be done. Integration with gig platforms, so people those who are not the part of formal sector can also take benefit. That's the global practices, life cycle investment planning tools, personalized dashboard, automated advisory nudges. Everything can be visible easily. So these can be embedded into India's digital public infrastructure to improve participation and decision making. Now, just to conclude, it is very important that, for example, if you just understand in the scenario of Indian economy from control to confidence, that's what government is trying to do. So regulatory balancing at growth versus stability. So it's all about you have to make a balance, then differentiated and proportionate regulation. So India's financial landscape is highly diverse. Urban market, rural market, segments are different, banks, NBFC. So our most important thing is regulation should enable trust, not just enforce compliance. Like for example, just tell me, when you see a police personnel in India, if you see a police wala, do you feel safe or do you feel threatened? Safe or threatened, just right. So, on the same lines, when investors sees regulation, they should feel that yes, it's not just enforcing compliance, it enables trust. अपन सोचते हैं ना, अरे पुलिस यहाँ क्यों खड़ी है, पुलिस यहाँ क्यों आई है. On the other hand, when you go to Jammu and Kashmir, Ladakh, Rajasthan border, Gujarat border, है ना, you see army, you feel safe. You feel safe. अरे यहाँ तो आर्मी पर्सनल है ना. So that's the perception. Perception of Indian economy regulation is exploitation, bribery. So that government is trying to change. So confidence plus participation, not fear. Okay, you can write this line. Strong markets. You write this line in your copy. Strong markets need confidence plus participation. Strong market needs confidence plus participation, not fear. Confidence plus partnership, not fear. Okay. So this is the end of the line. Here there are certain Viksit Bharat and all. We have already discussed that. Inclusion with stability. So majorly things are there. I will share this PPT with all of you. Okay. That's the end of the chapter number 3. We'll go the journey with till chapter number 16. Okay. If you want the PPT and all, connect on the number given on the screen. हाँ बेटा, वो एकदम से ना सिस्टम बंद हो गया तो सब कुछ चला गया. Schemes are not included in this. Schemes generally not, because schemes are same, Jan Dhan Yojana and all. चलो बढ़िया. एग्जैक्टली मैच का अपडेट दे रहे हो निखिल. I know some of you must be watching the match. आई एम इंटरेस्टेड यार, अभी अभी देखूंगा जाके। चलो अच्छा है। बीटिंग यूएस इज ऑलवेज फन। मॉर्निंग में तो मैं दुखी हो गया था, पाकिस्तान हारते हारते रह गया है।